Good afternoon and welcome to today's ASX Top 50 short form market update for the 18th of March. Any individual reading and listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals, and I have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. Today's format, we look at the macro update driving equities. We roll through the ASX Top 50. We summarise the recent first half of 2014 earnings. We look at the stocks that we are staying exposed to in portfolios on a 6 to 12 month outlook. We look at our recent transactions and conclude with a short-term market outlook. The services that we provide are based around an Investor Signals model portfolio of ASX Top 50 stocks. We use call options to enhance portfolio returns. We focus on effective ownership around ex-dividend dates. We look for above average cash flow as a result of call premiums and dividends, whilst also providing the opportunity for capital growth. It's a strict investment mandate that portfolios are managed under, so suitable for self-managed super funds, and the assets remain in your name. Presenter today, myself. If you have any queries on today's presentation, I'd like to discuss the Investor Signals Premium Account Service, please email or contact me, Leon at Investor Signals. Moving straight into a graph of the US market, the Dow Jones, as I covered in last week's recording, essentially the market's pricing in about 8 to 10% forward earnings growth for the S&P 500. If the S&P 500 delivers that in the next 12 months, it supports the current valuation. If, on the other hand, we were to get sort of a flat earnings growth story over the next 12 months, fair valuation for the Dow Jones is back probably somewhere around 14,500 to 15,000 points. So I think that gives you an idea of where the range. I think the risk to the market's no more than 10% of the downside. I think the fact that central banks are still willing to provide stimulus, and obviously whether that be out of the Eurozone, out of Japan, out of the Federal Reserve, or whether it's the Chinese relaxing sort of their lending conditions there to help stimulate the Chinese economy, which probably would be the least of the supported policies for global markets at present. But certainly the missing link, as I've been chatting about, is the Eurozone. If we were to see GDP start to pick up from negative contribution over the last 2 years to maybe 1 to 2% GDP growth per annum over the sort of into 15 and 16, I think we'll see continued ongoing growth in that environment out of the emerging markets. I think the most likely situation for equities is we get a period of consolidation until such time as it does become more of a synchronized global growth story. The bonds that I looked at again last week, what we're really seeing here is the 10-year treasuries in the US where they've pulled back from 3%. A lot of this February or January, February price action in the bond market has been a result of some of the weaker economic data that's come through from the December period in the US. When you look at the economic data that was out overnight in the US, we started to see the early signs of slightly better output of US manufacturers. So the utilities and mines increases seasonally adjusted 0.6% in February from the prior month. The NAHB housing index came in slightly below expectation. So the housing market in the US, I think maybe a combination of interest rates peaking there prior to December and the cold weather hopefully is all that is to blame for that sort of slightly weaker picture there in the US housing market. But I think broadly over the next 2 to 3 months we'd expect to see some of those indicators turn back up again in the US and continue to sort of support equity valuations at or near where they are at present. So in Japan, one of the big macro shifts over the last, say, 18 months has obviously been the stimulus measures coming through from the central bank in Japan, and that's put a lower downward pressure on the yen. We've seen the Japanese manufacturing sector and exports improve substantially. It's just worth just showing that on screen there relative to where we've seen around the same time a slight slowdown in manufacturing and output in China. The domestic market at 15 times forward earnings, just over a 4% dividend yield. I think our market still provides value, albeit in fairly select areas within the top 50. The main forecast here is that I think our downside risk to our market is probably no more than about 5 to 7% at about 5,200 points. I'd suspect that we stay in a range of 5,200, maybe up to 5,600 for the bulk of this year. The first stock that we look at in today's recording, AGK, the stock trades at about 4.3% dividend yield on about 14 times earnings. It was an uninspiring earnings result for the first half 14. I think out over the next 12 months, maybe the stock can grow 5% earnings. The range is sort of somewhere, buyers of it down here at $14.80 to $15, seller up there at around $16 in the case of AGK. Asiano, disappointing earnings result. We have that trading about 15 times earnings on a 2.5% dividend yield, but there certainly wasn't anything there in Asiano's earnings result that makes it inspiring. Amcor, on the other hand, we continue to like this. We've been buyers of it off this $10 support. I have it at 15 times earnings and about 4.5% dividend yield. We're owners of it at this level, but selling the covered calls up at around $11. I don't see too much upside potential for the stock much beyond that short term. ANZ, so the broad strategy here with the banks, we're looking for maybe another 3% move higher. So if ANZ can trade up to around $33, then we'll look to sell the covered calls into June, July. We'll collect the upcoming dividend in May. Underlying earnings growth here in the banks is probably not much more than about 5%. ASX, this is one of the stocks we like. I think after the recent sell-off here from sort of $38 back down to $36, I think it's a buying opportunity. It is expensive on 19 times earnings, but it's on almost a 5% dividend yield, and I think the company will grow earnings somewhere between 5 to 10%. It was a bit of a standout of earnings season, delivering 10% underlying EPS growth, which was a little bit ahead of market expectation. So we're buyers of it here and up at around $38.50, look to sell the covered calls. AZJ, continue to like this name. It's just a little bit expensive. The market's pricing in almost 20% earnings growth in the forward 12 months. Even if it was to deliver around 10%, I think it still sustains a valuation here close to $5. We're owners of it at lower levels, selling the 5.25 calls. So even for new money coming into the market, to pick it up at around this $5 level still seems reasonably appealing, as long as we can get those covered calls away up at around that 5.25 level. BHP, so as I chatted about last week, iron ore's pulled back from 140 a tonne to just over $100 a tonne, trading about 110 US a tonne. On that basis, if we factor in spot prices, we could expect to see downgrades to BHP, Rio and Fortescue over the next 12 months from an earnings perspective. If we form a view that iron ore trades back to maybe 120, 125, that would support a reasonably flat earnings outlook into 2015. So if we work on the assumption that BHP, given current spot prices, delivers fairly flat earnings in the 12 months ahead, the stock's trading about 18 times earnings and just on around 3.5% dividend yield. So I wouldn't expect there's the capacity from an earnings standpoint, given that I don't think iron ore is going to trade much back above 120 a tonne, for BHP's earnings to substantially outperform from the current valuation. Where we could see an uptick is if the company comes through and announces a share buyback or capital return in the second half of this year, and it looks highly probable that that's going to be the case. I think with that underlying support, the stock could trade back up to around $38 to $40. I don't see it having the capacity to trade too much beyond that. So any recovery from here back up to around $37.50 to $38, we'd take that as an opportunity to sell the $39.50 calls into the back half of the year. They'll be European style. We'll collect the upcoming dividend. I still think sort of BHP is a place to be over Rio or Fortescue. Brambles, continue to like this name, but it is expensive. Trading at about 18 times earnings on a 3% dividend yield. Looking for the company to deliver about 5% earnings growth, so we own it at lower levels, but at around this sort of $9.50 to $9.75, it's hard to build a case that the stock trades too much higher than that. CBA, continue to like this. It's obviously gone ex-div. Now the next banks in line are Westpac, ANZ, and NAB. So we'll probably see CBA flatline a little at 15 times earnings and a 5% dividend yield, about 5% underlying earnings growth. I really think it's just sitting in fair value at the moment. I don't see too much more upside push there on CBA. Coca-Cola, this last little leg of the sell-off, I thought around this 11.20, 11.40 it would probably find support. I still think it's good value down here. It puts the stock about 15 times earnings and about a 5.5% dividend yield. The company's earnings fell by at least 10% in the current result. It's the third disappointing earnings result we've seen out of Coca-Cola. The company needs to announce its cost-saving strategy to the market and some new business initiatives. But somewhere down here at around $11, I think the stock's going to find support, looking for it to trade back up towards $12 in the second half of the year. Computershare, I chatted also on this one. It's looking pretty expensive up here at 20 times earnings on a 2.5% dividend yield. Forward earnings growth, the market's pretty bullish, looking for something over 10%. I'm just not sure that Computershare can deliver that. So for our money, we're probably on the sideline more with Computershare at the moment, and we'll take a look at it on a pullback. CSL, continue to like this name, mainly driven by the company buying back still up to $900 million worth of shares. It's on 23 times earnings, so there's no doubt it's expensive. If we allow for around 10% earnings growth, it pushes it back down to around 20 times earnings. So it's sitting at the top end of the valuation range. It's hard to argue too much more share price performance from here, but we own it at lower levels, and we're selling sort of that $71, $72 call there in CSL. Crown goes ex-dividend, I think, next Monday. I think from an earnings standpoint, we've taken profit on Crown. After owning it at lower levels here at around $17.50, we started to take profit. So it's probably, again, not one of those names, and unless we had a sell-off back down to around $16.50, we'd be willing to take another look at it. Fortescue within the iron ore space, obviously the story with Fortescue, yes, they're paying down debt, with iron ore falling from sort of 140 back to 110. The prospect of the company sort of delivering increase in dividend yields, I think, diminishes a little, allowing for sort of forward earnings over the stock trading on around about a 3.5 to 4% dividend yield over the next 12 months. But around probably 450 the stock finds support, but not our preference right at the moment. Fox, continue to like this name, albeit they're clearly intending to delist from the Australian market, and that's going to put some downward pressure as Australian fund managers sell out of the stock. But the underlying business should grow by around 8%, and I think that's reasonably attractive relative to other areas of the market. Goodman Group, bullish outlook here from the company, delivering around 6 to 8% earnings growth, but on a 4.5% dividend yield. I just think that it's tough going to see property plays compress down below a 4% dividend yield and sustain that sort of price. So somewhere around this 470 to 485 is probably full value. Certainly if we were to go out 12 months, I think you could start to see Goodman Group trade back up closer to $5. But right at the moment, I think the compressed valuation for these property plays on a yield perspective is about 4.5%. They're just unlikely to support further price rises and further yield compression. GPT fits into that same boat. They're trading about 14 times earnings on a slightly more attractive dividend yield at about 5.5%, and hence this is the name that we're preferring to have exposure to in portfolios, albeit we're capping it up here at around this 370 level into June. We've collected a reasonable premium for that, so giving us an effective exit price up at around 385. If the stock was to continue to bounce sideways, a combination of collecting that div and the call premium, we're driving around 10 or 12% cash flow. Underlying growth for GPT is not quite as good as Goodman Group. They're probably somewhere in the order of 4 to maybe 6%, so a couple of percentage points lower than Goodman Group. But GPT, the company's buying back their shares, and I think at the margin that puts a little bit of a safety net under it, so our preference is GPT. IPL, we've sold the covered calls here after the stock having a great run at 14 times earnings and a 3.5% dividend yield. The company should deliver about 10. The market's looking for around 15% earnings growth. I think that could be a little bit optimistic. I think especially with the Aussie dollar trending back up off its lows. So I think around 10% forward earnings growth for IPL. puts the stock at about 4.5% dividend yield into 2015. So somewhere around this $3 range, the stock consolidates. We've sold the covered calls, giving us an effective exit price up here around $3.20, but I'd expect the stock to largely bounce sideways. Lendlease, we've been owners of this at lower levels. This has been one of our recent purchases and one of our preferred exposures in the market. They're the preferred bidder for the new Transurban contract there for the North Connects project in Sydney. But in general, the commentary out of the management team at Lendlease would suggest that after a fairly flat earnings result for first half 14, over the next 2 to 3 years we'd expect to see Lendlease accelerate back up to 8 to 10% earnings growth. From a valuation standpoint, we have Lendlease on 12 times current earnings and about a 3.75% dividend yield. So short term around $12 is where we see resistance, and we've mostly been selling covered calls up at that level. If we were to go out over the next 2 to 3 years, I think Lendlease could support a valuation where we see the stock eventually trading back up towards $15. So it's one of those names that we'll continue to look to keep exposure to in portfolios. It's one of the strong sort of growth opportunities, I think, within the Australian market at present. MGR not doing there at the moment. Macquarie, I chatted about this one again last week in that it's getting expensive, 19 times earnings. The market's looking for 20% earnings growth into 2015. To the extent where portfolios own Macquarie, well, I think now's the time to start trimming and taking a little bit of profit off the table with Macquarie. The company has to deliver somewhere in the order of $3.66 of earnings per share in FY15 just to support the valuation, and as I mentioned, that's almost a 20% growth on where it was in 14. And I'm just not sure that I think at best we get into an environment where Macquarie really moves sideways for a little while, given sort of that high forward earnings growth expectation that's already priced into the stock. NAB, we continue to like the banking stocks, looking for about another 3% move higher. In the case of NAB, somewhere up at around $36 European style call to collect that extra call income, and the May dividend I think is the right approach there in NAB. Origin, we've sold the covered calls at around $15 to put some valuations on Origin, trading 20 times earnings. It's on 3.5% dividend yield. They didn't deliver much in earnings growth in the first half. I think it's a 2015 recovery story from an earnings perspective, and in that environment the company may return back to around 8 to 10% earnings growth in 2015. Even on that basis, it puts it at 17 times earnings. So again, I think we're in for a period of consolidation. So you can see as we go through these names from a valuation and a yield perspective, and from an earnings growth probability, the balance of probability would suggest that we're more likely to have a period of consolidation for the Australian equity market, or for at least these large cap names, which should mean that it provides a good environment to sell the covered calls and drive the extra income out of these names. I really think the bulk of the share price expansion that we've seen over the last few years has largely been attributed to the low global bond yields, companies buying back shares, and management being very tough on the cost side of their businesses. And I'm just not sure that some of those factors will be as strong as what they have been over the last few years. So I think we get a period of consolidation, but the probability is that we do get sort of synchronized global GDP, and that starts to sort of underpin forward earnings growth again. Rio, so to put some numbers around Rio, have that trading 10 times earnings on a 3.5% dividend yield. But again, with iron ore prices at where spot levels, the probability of Rio delivering earnings growth into 2015, and to give you an idea, the market had an expectation that the company would deliver around about 8% earnings growth into 2015. If spot prices were to stay roughly where they are, really puts the stock back on sort of current valuations, which is about a 3.5% dividend yield. So I think sort of in the absence of Rio announcing the special dividend or share buyback, which they're probably more focused around paying down debt, especially if iron ore prices stay low. I think the argument, really is to stay exposed to BHP over Rio. Stockland, so I think along with Lendlease, this is one of those names that I think makes sense to have exposure to. The growth in Lendlease is likely to be a lot stronger than Stockland. Stockland pays out close to 100% of its earnings in dividends, so they don't have that capacity to increase their dividends beyond sort of what the earnings growth of the company is. If the company delivers around sort of 5 to 8% earnings growth, it puts it on about 15 times forward earnings and a 6% dividend yield. We own it at lower levels, looking to sell the $4.10 covered calls over Stockland's. Sonic, this is a name that we've just started to step back into the market, buying it at around this 1750 level, selling covered calls up at around the 1850 level into the second half of the year. The stock's expensive at 18 times earnings, but on a reasonably defensive 4% dividend yield with the covered call, it becomes an attractive proposition. Santos down here at around 18 times earnings, 2.5% dividend yield. I think you're probably looking at an inflection point where Santos finds support. We do own it at this level. We've sold the 1450 covered calls and we've collected the recent dividend. So looking for the stock to put a base in and move sideways, and then maybe towards the second half of the year start to improve. Transurban, coming into its dividend in June. Transurban trades on about a 4.5% dividend yield. I don't think we're looking for too much more compression in yield from where it is at the moment. The company should deliver about 34 cents of earnings in 2014. In 2015, we may see that tick up by about 8 to 10%, and we'll see around 38 cents of or dividend per share, I should say, in 2015, which in that environment would put it on a yield of around 5%. So I think the range for Transurban is certainly 7 to maybe pushing up to 750 towards the end of this year. It's one of our preferred defensive plays in portfolios. We own it at lower levels. We've sold the covered calls around the 725 level, and we'll continue to keep exposure to Transurban. I think on the next sort of couple of years we could see the stock sort of trade between that 7 to 750 range. Telstra down here, we've seen Telstra on a 15 times earnings and a 5.5% dividend yield, or getting close to 6% dividend yield here. The earnings were roughly, dividends per share were around 29 cents. The earnings per share were around 32 cents in 14. Coming into the August dividend, I'd expect to see the stock trade back up to around $5.25. So we're happy to be buyers of it down here at around this $5 range. Toll, disappointing earnings result from Toll. At a 5.5% dividend yield, the stock should start to find support. I don't expect to see any substantial earnings weakness. It's just that on a forward outlook, the company's probably not likely to grow earnings any more than sort of flat to 5%. Westpac, 5% underlying earnings growth. A reasonable buying opportunity still here. I think Westpac could trade sort of 34.50 coming into the May dividend, but we broadly own it at lower levels, and we're looking to sell the covered call up at around that $34 to around $34.50 into that sort of June-July period and collect the upcoming May dividend. WDC, continue to like this within the property space. The outlook here for WDC is that the stock's on 15 times earnings and a 5% dividend yield. The company will probably look to grow earnings at a rate of around 3 to 5% on a forward outlook. It may support a price move back up to around $11, but nothing too much beyond that. Wesfarmers, I'd warned in previous weeks' recordings that up at this level at 20 times earnings and on less than a 4% or getting down a low 4% dividend yield, the stock was expensive. However, the probability of the company continuing to drive 8% underlying earnings growth, I think, means that we get a period of consolidation, and then certainly on a 6 or 12-month outlook, I think the price can push higher again. So we own it at or near these levels. We've sold the $44 covered calls. A combination of that premium and the dividend, we're driving in excess of 10% cash flow there out of Wesfarmers. Woolworths, we just collected the 65 cents of dividend here out of Woolworths. Again, to put some numbers on this, the stock's 19 times current earnings on less than a 4% dividend yield. Even if the company delivers underlying earnings of around 6% into 2015, it puts it on 17 times earnings and just over a 4% dividend yield. So I think similar to the view on Wesfarmers, Woolworths probably will track sideways, and owning these names, you'd really have to be selling the covered call to drive that return out of it, as I think the probability of getting capital appreciation out of these names starts to diminish a little bit on a 6 to 12-month view. Woodside Petroleum, we continue to like this at 12 times earnings, 6.5% dividend yield. I think it will be well supported at around $38, but we're certainly selling the $39 to $40 call to complement that, again driving up to around 12% cash flow out of owning Woodside Petroleum. And finally, WRT, at 15 times earnings and a 6.5% dividend yield. Not a lot in the way of underlying earnings. We're waiting to see whether WDC come back and sweeten the deal for the demerger of some of their assets and the acquiring of those by WRT Trust. In that environment, we'll see the share price perform better, obviously, if WDC sweeten that deal, but otherwise, on an underlying business growth standpoint and dividend yield, probably the resistance or the top of the valuation range is up at around $3.20. So if we can own it at or near these levels, sell the $3.20 call, collect some extra premium for that. We've just recently collected the dividend in February. We collected again in August. Combine that with the call premium, we're getting again up around 10 or 12% cash flow out of WRT and allowing for some capital growth. And finally, just to conclude today's recording with the view on the market. So as you would be aware from both the introduction and running through the top 50 stocks, how we're setting up portfolio allocations on the assumption that most of the market is likely to move sideways. There's a few select areas where we see some capital growth, a little bit of upside in some of the property plays, Lend-Lease, some further headroom in a few of the banking stocks, but otherwise the strategy really is sort of finding these high-quality defensive names, selling the covered calls, collecting the premium and the dividend, and continuing to sort of drive that 12% cash flow out of the market whilst the bulk of the market sort of moves sideways. Thank you for listening in to today's recording. I look forward to speaking again next week.